The 1, 2, 3 continuation play. This is not just something that you would look for on a daily chart. This could be played on intraday time frames as well. So this is the only guerrilla tactic that you can actually play on a 1 minute, a 2 minute, a 5 minute, etc. So the setup is bar number one has to be a wide range bullish 2020 bar igniting a move, right? That's the key here. This is igniting a move. It's not ending a move. Bar number two ideally stays within the top third of bar number one without trading above the high of bar number one. Now, for me, I don't adhere to that rule in absolute. Meaning, if we trade a little bit above bar number one's high, right? If we get a little bit of a topping tail or something like that, it's not the end of the world to me. Ideally, it stays below it, but if we get a little bit of a tail there, it doesn't negate the trade for me. Right? So this is again the setup. And as I said, this works well on any time frame that you trade from. So now the action is going to be to buy when we trade above the high of either bar number one or two, whichever was higher, as that signifies a 2-bar breakout. The stop is going to be placed under the low of the inside bar, under the low of that bar number two, right? Or sometimes it might be the trigger bar, depending on if it tried to move lower first and came back up. Basically, as we've continued to say here, whichever's lower. And then you're going to use your trailing stop. Because this is generally in the direction of the trend and in the direction of a move that is just getting ignited, you don't have to sell it for, the second day. You can manage it based on your trend rules, your trend management rules. So as it pushes on up into the next area of resistance, a multi-bar trail, whatever the case may be. Here you can see an example of a 1, 2, 3 continuation play. You've got your wide range bar igniting the move up. Inside bar, you buy the break over those highs, looking for continuation. Your stop goes under the low, and you get a beautiful move out of it. And now this wasn't the only opportunity on the chart, but that is the context of our discussion here right now as the 1, 2, 3 continuation play. Right? So again, wide range bar up, inside bar, play it over the highs, off it goes. This is a daily chart, but as I said, it doesn't matter what the time frame. You need volume igniting the bar. You don't necessarily need volume igniting the bar. It would be nice if you do, but it's not necessarily a requirement because I've seen times where, as you can see in this example, you don't really have a huge volume surge, but then as the stock continues to move higher in your favor, you do get that igniting type of volume. Question, okay? And where do you look at as the target? You'd have to look off to the left. We can't see anything on this time frame, but you'd have to be looking off to the left to identify where the next area of either support or in this case resistance resides. All right, so here again, daily chart 1, 2, 3 continuation. Here you do have that igniting volume with the wide range bar breaking out of a stage 1 consolidation. So here you get your inside bar and 1, 2, 3 continuation entry the following day. So you'd buy it again as it breaks over those highs. Your stop goes under the low of the bottoming tail. And then where do you set your target? I mean, looking at this, you could be looking at a target somewhere up in the $46 area. because there's nothing else to stop it. I mean, it's got room to move up. Maybe, and quite frankly, I mean, I wouldn't be too concerned with this area right here because we've moved away from it over time. Here we are several months later. This to me is not as significant, which is why I say it could move deeper into this area, pushing up towards 46. Okay. But this was a really nice setup. And like I said, I mean, this is a daily chart, but honestly, you can see these types of things happening on intraday charts as well. Speaking of, here you have a 60-minute chart. Gaps up, wide range bar, clearing resistance. So stage one into transition A that should become a stage two. Now it takes a couple extra bars here, so there are times where you might get an extra bar of stabilization, in which case we might just call it a 1, 2, 3, 4 continuation play. Entry is still the same. You're going to buy it as it trades over the high of those candles. Okay. Now, this obviously begs the question, well, what if you get another candle going sideways? Do you then call it a 1, 2, 3, 4, 5? And if so, where does that stop? So no, you don't call it a 1, 2, 3, 4, 5. At that point, if you get another bar of consolidation, it's becoming a pause that refreshes. At which point you're just still looking to buy it above the top of the range, but you're not going to call it a continuation play. Instead, like I said, it's going to be viewed as a pause that refreshes. Okay. So now here we've got another chart intraday. Gap up off the open. First candle here closes with a wide range bar. You get an inside bar following it. 1, 2, 3 continuation. Buy it over the high. Stop under the low. Really tight. Stop there. And then boom, off it goes. Okay, so this was a nice intraday continuation. And I'll tell you what, this isn't going to follow through in the way that it does unless the larger time frame is also bullish. Right? So you can pretty much guarantee the larger time frame here was in agreement with this intraday chart. The next example here is your bearish 1, 2, 3 continuation. So everything that we just talked about, now reverse it. You've got a wide range bar down, igniting a move, followed by bar number 2, which ideally stays inside of bar number 1's range, but doesn't have to. Like I said, if it tries to dip a little lower, comes back up, that's not the end of the world, because I've seen those patterns work out exactly as you would want to see them anyway. So you're going to short it as it breaks down below the low of either the inside bar or the wide range bar, whichever is lower. There differences for expectations in terms of target relative to time frame? Yeah, that's just, I mean, you're not going to expect the same kind of target necessarily because, like you said, 5-minute isn't going to be trading in as wide of a range as, say, a daily chart. So by default, that is true. The expectations will be different, but the approach is no different, right? It's all relative. On a 5-minute chart, you're still going to look to where's the next level of either support or resistance. So the approach doesn't change, but right, since the time frame is smaller, you're not going to make as much necessarily trading off of a 5-minute as you would off of a daily. All right, so here you've got your bearish 1, 2, 3 continuation setup. breaking down with a wide range bar from a sideways stage 3. You've got the volume coming in as well. Inside bar. So what are you looking to do? You're going to look to sell it short under these lows. Your stop will go over the highs. And then as far as a target goes, where are you going to look? Now, I personally would be looking for it to come down into the $23 area in that level, not necessarily down in here, because the wide range bar is igniting a new move. My expectation is that that first level right here is going to be exceeded. Okay. Last slide. Let's go here. I saw use trailing stop. How do you calculate that based on the price of the stock? I wouldn't use the price of the stock to calculate your trailing method. I would use whatever is comfortable for you, bar by bar. So as each new bar forms in the move down, bring your stop to just above that bar's high. If you want to use pivots, you could use price pivots. Some people choose to use a moving average, but I wouldn't try and calculate a percentage trail stop based on the price of the stock. You don't necessarily need downward sloping moving averages to enter in any of these, because sometimes they're taking advantage of sideways environments. And like we just looked at here, the moving averages are beginning to slope down. But remember, moving averages, they're basically magnetized by price. So whatever price is doing, price moving up or down is what's going to pull the moving averages. So in order for these moving averages to begin sloping down, you're going to have to see additional follow through lower, at which point it would be too late. So no, you don't necessarily need the moving averages to be sloping downward to enter shorts or up to enter longs within the context of these patterns, or even transitions for that matter. Here we've got another bearish 1, 2, 3, 4 breakdown, wide range bar, igniting the move with volume. You get your couple bars of consolidation, topping tails telling us that the supply is increasing. You look to short the breakdown here, right? Short the breakdown under these lows, and then boom, down it goes. And not only that, but as it begins to fall, it goes climactic. You could have looked to then reverse. You could have looked to cover your short and then get long based on the climactic buy setup. The next guerrilla tactic is the bearish mortgage play.